Thank you, Martin. I'm Aaron Klein, Director of Policy at the Institute on Business and Public Policy. It's a great pleasure. I think everybody just stay seated. Greg, you'll go first so you can be on deck right there. I'm going to introduce everybody, we're all here and staying here late on an afternoon because we're kind of in on the secret, which is that while the equity markets make the headlines, the debt markets and capital markets make the economy. And concerns about liquidity in those markets are really paramount to the functioning of our financial system and ultimately our entire capital-based economy. I'm also going to let you in on another secret, which is I've seen the decks, and the slide presentations you're about to see are excellent. So I'm going to challenge everybody who's here, who's on social media, to pick out your favorite slide, take a picture of it, tweet your thought about it with hashtag liquidity, and stay engaged here, because what you're going to have is fantastic diversity of thought. All three people I'm about to introduce are Harvard graduates. And I found this out reading their bios. But what they do is they come with three very different worldviews, very different chairs and experience in how our capital markets work and how liquidity and liquidity-based regulation can make things better or worse. And so I'm going to go in order of their direction of how they're going to speak. First, we're going to start off with Greg Baer. Greg, to my right, is the president of the Clearinghouse Association and executive vice president and general counsel of the Clearinghouse Payments Company, which is the oldest private sector payment operator in the U.S. In fact, the Clearinghouse really was America's central bank during the long period in American history between the second and third central bank. We heard from the Vice Chair, Mr. Fischer, of the Federal Reserve, which is really America's third central bank. And there was a long period where we didn't have one, and the Clearinghouse filled that role. Previously, Mr. Baer has a distinguished career in government, where he served as Assistant Secretary for Financial Institutions in the U.S. Treasury Department. He's also served in the private sector at J.P. Morgan Chase and Bank of America, and also was at the Federal Reserve. So, Greg, you're going to go first. Second, we're going to hear from Andy Green. Andy's the Managing Director of Economic Policy at the Center for American Progress. Previously, he served as counsel at the SEC, where he worked closely with Commissioner Kara Stein. And many of us in the room know Andy from his tireless work in helping really draft the Dodd-Frank Wall Street Reform and Consumer Protection Act during his perch as the senior financial advisor for Senator Merkley, where Andy was intimately involved in lots of parts of Dodd-Frank, including one small provision known as the Volcker Rule, which many of us have spent a lot of time thinking about. And then finally, we're going to hear from Jason Carroll. Jason is the managing director at Hudson River Trading, and he helped found the firm in 2002 and is still there. And not only is he running one of the largest trading firms, so you have somebody who runs banks and settlement, somebody who worked on the Hill and at the SEC as a regulator, somebody who works in high-frequency trading, actually making markets, as I think Barbara Novak alluded to, one of those companies that you don't know their name but really is the large participant now in that world. And he's also actually been a contributor to the architecture of many other software systems throughout, not just Hudson River Trading, but throughout the industry. So with that, I'm going to take it away and let Greg tee us off.
Thanks, Aaron, very much. So let me see if I can make this work. I can make this work. It's always a pleasure to be at the Brookings Institution. It's also a pleasure to see so many familiar faces out there. It's a real privilege to be here. It's funny, I was going to start with the definition of market liquidity, and it's funny, a year or two ago when I used to give talks like this, everyone felt the need to begin by saying market liquidity is very hard to define and everyone has a different definition. We've now reached the point where everyone has the same definition. I think this may be verbatim what Vice Chair Fischer said this morning, perhaps with immediately added, but I think that's at least some progress. The other thing I'd note here is that if you think about dealer liquidity, there's really two forms of it. First is the traditional market-making role, which I think has been discussed a lot today. And the other is actually providing balance sheet to other firms that want to buy or sell, asset managers, hedge funds. And I think that gets a lot less attention, but as we talk about regulation in the minutes to come, I think you've seen just as much impact on that function as you have on the market-making function. And speaking of sort of dealer functions, I did want to stop at this point and sort of address what I call the catch-a-falling knife canard, which is this notion that dealers don't make markets in stress, they only make markets in good times, so why do we need dealers? And I think that's worth a moment to discuss. I mean, liquidity is always pro-cyclical. If you think about a dealer sitting on a desk with a risk limit, if there are troubled times, the VAR goes up. It's tougher to stay under those limits. So either you have to ask somebody to raise your risk limit, or you have to trade a little less. And of course, they don't ask for their limits to be raised in pressure. They trade a little less. So there's nothing sort of surprising or mysterious about that. But it is the case that dealers make markets in stressful situations. They made markets throughout the financial crisis. They made markets through Brexit. They made markets last Wednesday. And it's important to understand, for purposes of this session, why do they do that? First, mostly they do it to make money. It's actually profitable to buy when everyone's selling and sell when everyone's buying. Volatile markets are more profitable for market makers than placid markets. I think that's one reason you've seen high profits the last couple of quarters, is because they were actually catching, if you want to use the analogy, they were catching knives. You don't make any money by leaving them on the floor. The other important thing is the other reason they continue to trade in stress is because of client relationships. Dealer liquidity is liquidity with a name attached to it. So if you're running an electronic trading firm or a hedge fund and things get tough, you can turn off the machine, you can go to the Hamptons, and you can come back the next week and you can start your business again. If you're a dealer and you do that, well, your customers won't deal with you the next week because you let them down when they needed you, and they will deal with someone who did deal with them. I actually think the much better analogy is Uber in the rain, which I was thinking about the other day. If you've noticed, if you're trying to catch an Uber and it's raining outside, you'll find that there are fewer available, there's a longer wait time, and also that there's surge pricing. Now, when that happens, I think that's pretty smart. That's pretty cool. I don't say, why won't Uber catch a falling raindrop? I think that's sort of the way it works, and it makes me sort of wish there were more Ubers in good times and more Ubers in bad times. I think this is a fairly self-explanatory explanation of consequences of illiquidity. I'll skip that. And I think we've had a fair amount of discussion today about how complex, I know Debbie did a good job with this, about how complex the environment is. So it is kind of a hard and noisy environment to assess market liquidity. This takes a little more time. And again, I think we've had some discussion during the day. While I think there's a common understanding of the definition of market liquidity, there is no common understanding of the best way to measure it. I think Vice Chair Fischer actually walked through dealer inventory, turnover ratios, block trade size as potential indicators of less liquidity, and then volume of issuance and bid-ask spreads as evidence of stable liquidity. I would have two caveats on volume of issuance and bid-ask. First, on volume, and obviously this has been discussed today already, is that in the current historically low interest rates, there's going to be a major incentive to issue. There's also sort of switching hats to the other side of the bank. It's become more difficult to get bank funding. So there's a further incentive to issue. And then on bid-ask spread, I think it's important to note, and this is sort of a conundrum, that bid-ask spreads are actually narrowest in completely illiquid markets, in an agency market. Because there, the bid-ask spread is not compensating for market risk, it's just for operational risk. So, if you take it to its extreme, you will see very narrow bid-ask spreads in markets without liquidity. And there's also, and this gets to the to-be-determined part, there's also, using a Fed analogy, there's a discouraged worker problem. If you call your dealer and ask to trade $10 million, and they say, well, we're never going to trade $10 million with you. We did in 2007, but now it's the most we'll do is $1 million. Well, you'll stop calling and asking to trade $10 million. And the spread on the $1 million trade will obviously be much narrower than the spread on the $10 million trade. So these are noisy measures. It's not to say that one is terribly imperfect and one is absolutely perfect, but there's certainly a room for argument on each of them. I think this is where I think the bifurcation point becomes important because, again, as I note at the end, what you see may depend on where you look. And I think Debbie introduced this concept well. We are seeing liquidity clustering in the largest issuances. So if you look at the largest issuance, you will see more liquidity. Liquidity clustering in on the run versus off the run. And then two others that I think are worth noting. One, I think she noted with respect to BlackRock, which is balance sheet more frequently provided to the best and biggest customers, the largest asset managers, less to others. And then a kind of bifurcation, which is, and I think it's one of the most dramatic demonstrations that there is a regulatory effect going on here, is the number of exits from these businesses, from fixed income currency trading. You actually used to carry around a list, but couldn't keep it updated fast enough in terms of the number of banks, mainly European, but also U.S. banks or broker-dealers getting out of all or some or scaling back appreciably in these businesses, which appears to indicate a problem. And then I also think it's important not to underrate the anecdotal evidence. For the example I just gave, where the data can sometimes be confused by people's changes in behavior. Certainly, if you talk to sell-side or buy-side participants, they will tell you they can't get trades done in the size they used to be able to do them. If you read analyst reports, they're talking about how do you trade now in an environment where we're moving from principal to agency markets. They're not complaining about it. They're just saying, here's how you trade those markets. Again, I think to the extent that the Europeans did a call for evidence, they heard about this in spades. And so, my analogy here, I don't know if anybody understands the reference. There were in the 1960s and 70s a lot of academic studies, oddly, about whether one could climb Mount Everest without oxygen. Could you get enough in your lungs at 29,000 feet in order to survive? And the general conclusion of the scientists, doctors, was that you could not climb Everest without oxygen. And then in 1978, Reinhold Messner climbed Everest without oxygen. At that point, they stopped studying it. They didn't say he didn't really do that, or you shouldn't listen to Reinhold, or he's a complainer, or anything like that. So I think the other version of this is the Chico Marx version, which is, I think, frequently what at least I hear from dealers and asset managers, which is, what the academics are saying to them is, what are you going to believe, me or your own eyes? So kudos to Chico on that. So I do think there has been an unfortunate sort of divergence in views between sort of pure academics and pure dealers. That's one reason I commend the Brookings Institution for bringing people together to think about this. Let me go on to the next. Just some touchstones. I won't dwell on these. The CFA survey, actually, if you look at items 3 and 4, really reports, I think, what at least I hear from dealers and asset managers. The Bank of England, that's self-explanatory. There are certain aspects of the market where we are seeing peculiarities, which do seem to be attributable to regulation. If you look at GCF Treasury repo versus tri-party, there are differences that really shouldn't be explained by credit quality. It's very complicated, but the BIS has actually been very focused on violations of the covered interest rate parity rule, which is basically the idea, I hope I can get this right, that if you borrow in dollars, you should be able to buy yen, borrow in yen, and use a forward transaction to come back to dollars at exactly the same price, and that any difference should be arbitraged away. It's currently not being arbitraged away. I think it's an interesting question why. It's certainly one they're quite focused on. I will skip charts that everyone else has already shown you. This I wanted to flag because this is actually the one Martin referred to earlier, which I think is actually quite interesting. And it's easy to say, is there a crisis in liquidity? I don't think anyone would say there's a current crisis. But this certainly is an indication there might be something wrong that's having real effects. So this is looking at corporate debt issuance by firm size. And what this appears to indicate that, again, to the extent that there's clustering and bifurcation, that there's a lot more liquidity if you're a large issuer issuing in size and issuing regularly. And so you'll see firms with assets over $50 billion, their issuance has gone up significantly since 2010. Again, another reason for them to want to do this, again, bank credit lending has become more expensive, so capital markets are a cheaper alternative, and of course, historically low interest rates. So the tougher question is, why are firms below $5 billion actually issuing less debt? And that's not one I don't think has gotten enough attention, but certainly maybe indicative of some of the problems that we've been discussing today. So this now gets to the question of, what's the role of regulation in all of this, which I'm impolite enough to bring up. I certainly say at the beginning, of course, things other than regulation are at work here. People who lost a great deal of money in the financial crisis readjusted their models. They took in events that they had not previously considered. And of course, their appetite for risk was going to be lower, absolutely. But it's also the case that things like the US ESLR, the GSIB surcharge, where I think 4.5 of the 5 factors go to market making and capital markets activities, the LCR, are all reducing dealer appetite to hold inventory and make markets and fund others' transactions. And then we still have pending the NSFR, which one analyst I think cleverly dubbed not suitable for repo. The NSFR, I think, has morphed in terms of its purpose a lot since it was originally proposed, and I think actually candidly now really has no purpose. But the one purpose you hear most offered for it is we need the NSFR to get to matchbook repo. And in particular, I think you hear from US policymakers that we need this for the Europeans to get to matchbook repo. Unfortunately, the Europeans have recently made clear that when they implement the NSFR, they're going to exempt matchbook repo. So then we consider that in the US, we have already addressed matchbook repo through a change to the GSIB surcharge, which is actually kind of sensible, which was to have a short-term wholesale funding component, which penalizes matchbook repo. And then also the ESLR also punishes matchbook repo. So we are now on the verge of solving for the third time a problem that the rest of the world has not solved at all. The next, of course, is CCAR plus GSIB. If you add a capital markets tax in the form of the GSIB surcharge to CCAR, which is already the binding constraint for most, that will give further incentives to diminish the activity in this area. And basically, the effects you see there are higher costs of holding, hedging, funding. And so it's not altogether surprising that you would see less dealer activity in this area. I won't talk too much about electronic trading as the solution. I do think it's fair to note, though, that electronic trading lowers transaction costs, but it does not bring any additional principal to the markets. So it can facilitate an agency market, but it doesn't necessarily recreate a principal market to the extent that those who had principal at risk businesses exit them. Last page, second to last page. So I'm going to, just as a quick aside, and I was talking about this with Aaron, and I think maybe it's a subject of a future Brookings conference, and it's come up a little bit today. These regulations, these incredibly high capital liquidity regulations, some of which are justified, and at some levels, are really imposed on non-bank affiliates of banks at full levels. They are not imposed at all on non-banks that aren't affiliates of banks. And I think it's a great question now that we're sort of reimagining bank regulation. Why is that? Is it really because we believe that Goldman Sachs' broker-dealer is going to bring down its relatively small bank and cause a loss to deposit insurance fund that isn't going to be replenished by TLAC and selling assets and doing an assessment on the rest of the industry? That can't be. I sense that the reason we're regulating that broker-dealer is because of concerns about systemic risk and financial stability. And if you're doing that, why aren't you regulating other firms that pose the same risks in at least roughly the same way? But that's I hope, maybe a future conference. What I really think I want to emphasize here is that it comes down to policy choices and trade-offs, I think someone mentioned earlier. And what's the cost of doing more in terms of capital and liquidity regulation in particular, and what's the benefit? And the choices we have now, again, no one would say we're in a current crisis, but I think we've seen reasons for concern. We've seen the flash events, which I know have been much studied. And I think it's important not to study them so much that we end up concluding they never happened. They actually did happen. So there does seem to be some room for nervousness, and I think you saw a range of nervousness on the previous panel. So the options here are we can continue to study, and we can see what happens when rates rise and the balance sheets unwind and take that into account. We could take actions to restore market liquidity or replenish it, along the lines of ESLR and other things. We could regulate the buy side on the assumption that there isn't a liquidity. There's a little bit of a cognitive dissonance because some of the people who are saying there isn't a market liquidity problem are actually saying we need to regulate asset managers on the assumption that there is. And then we could take further actions to reduce market liquidity. And that's the NSFR, GSIB, and then potentially fundamental review of the trading book. And right now we were sort of on the path to the last option and perhaps combined with the third. To me, it's a classic cost-benefit analysis, and it comes down to what are we worried about more in terms of the next financial crisis? Are we more worried that there's going to be a problem with liquidity, generally? Are we more worried that non-bank affiliates of banks are not going to have sufficient capital and liquidity to weather that crisis? And I think that, in turn, leads to the question, which really hasn't been asked much today or anywhere, what's the evidence that large broker-dealers that are affiliated with banks have insufficient capital and liquidity to weather current and future events? And so that's sort of my last slide. That would be cricket stripping. It's actually a tribute to Vivian Liu on our research team, who was the first person to tell me that PowerPoint actually has audio. So I wanted to thank her for that. But with that, I will step down. Thanks.
Good afternoon. Thank you, Hal. Thank you, Martin, who I met today, for having me here today. I'm learning a lot. Hopefully, as a practitioner, I can share some information about liquidity that comes from a slightly different perspective. I founded Hudson River Trading in 2002 on the premise that a computer algorithm could connect the dots between technical market data and manage risk more efficiently than humans. At the time, we called ourselves an automated trading company. Since then, obviously, we've become high-frequency trading companies. While we accept the term high-frequency trader, our goal was not to make vastly different decisions than human intermediaries, but to automate that service, and in so doing, provide it much more cheaply. Today, our company trades about 10,000 financial products around the world, with a team of 160, and we make about 100,000 trades per person a day. If you look only at the people who are actually engineering strategies, it's more like 250,000 trades per day, per person. Our topic today is liquidity in a post-crisis world, and in particular, one of the things I wanted to speak to was whether or not flash crashes are a sign of poor liquidity in today's markets. So I wanted to walk you through a recent flash crash and discuss whether or not it should be viewed as an indication of weakening liquidity. Two events happened this year. Vice Chair Fischer referred to both of them. On June 23rd, Great Britain voted to leave the EU. It was widely, sorry, these are both events in the British pound currency market. On June 23rd, Great Britain voted to leave the EU. It was a widely anticipated event. Everyone knew it was coming for weeks in advance. The vote was assumed to go one way, but it was not set in stone. Everybody was paying attention. So while the outcome was not what people expected, largely people were paying attention. Prices moved substantially. The prices stood up to the qualitative story of what happened. Largely economists viewed this as a bad decision for GBP, and there was a sell-off in the pound. Because we had substantial notice, because the price didn't really surprise us in the direction it moved, and because we have this story about kind of everything that happened, we don't really view this as a flash crash. On October 6th, we have a different story. It happened at almost the same time of day in the evening, just after 7 p.m., East Coast time. There was no notice that anyone was going to do a lot of trading at that time. When you look at the price history, the pound way overshoots where it ends the day, and the price is quite stable both before and after the sudden move. Afterward, we're left asking the question, well, what happened? Why was there a 5% move in the pound? This doesn't make any sense. We're going to call this a flash crash. So I have a little bit of data. This is not professionally produced, but so this is price history on June 23rd in blue and on October 6th in orange, and unfortunately that lines up almost perfectly with the crease in the display here. But I guess you can measure by the narrowness of the margin between the TVs how quickly the price fell on October 6th. So on the 23rd, you can see that there is substantial price action. In fact, there is a similar drop right around 720. But it has a story behind it. We're not surprised. On October 6th, on the other hand, the market is relatively stable before and recovers after about 11 minutes and is again stable again. And again, this is what we call a flash crash and leaves people a little nervous. Here's a volume chart, and sorry I don't have this overlaid on top of the price chart, but generally the peaks in volume correspond to big price moves. So the blue columns are, again, for June 23rd. This is grouped in millions of pounds traded per 15-minute interval with times across the bottom. And so you'll see, some very small, very high peaks on June 23rd around some of the price moves. On October 6th, the market is quiet before 7:07 when the crash starts. There's no action at all. And if you look at every other day in the British pound, other than June 23rd from 2016, you will see a very similar market. This is what the market looks like at 7 p.m. The US markets are closed, European markets are closed, Asian markets are barely opening. There's usually not a lot of action here, and when there's not a lot of action, there's not a lot of attention paid to it by liquidity providers such as ourselves. So a couple of points. Zero market activity before October 6th. The other thing I would point out is that while this looks like a market in free fall at 7:07 on October 6th, there's actually a considerable amount of volume that happens very close to the price that the currency opened at. About $500 million of GBP trades before that price moves down very much. Over the course of the next 11 minutes, an additional $1 billion of GBP trade, but the first third of that volume happened before the price dropped below the eventual closing price. And the last point I'd make is that even though there is a 5% dip immediately, and ultimately the price goes down about 2.5%, the average price during that moment of chaos really is only 1% below the steady state price toward the end of the day. So you see very low prices that you're not excited about, but not a lot of volume trades down there the average price is a lot higher. So maybe the people involved here weren't as significantly impacted as we seem to think. We still don't like this. You know, we have computers now that are supposed to be always on. Why don't computers, automated traders like myself, do a better job of protecting us against immediate price moves like this? Don't worry, there's not a here's how HFT slide works coming up. So I wanted to talk a little bit about what is typical of HFT strategies. Most people seem to think that HFT is very good at understanding news. Artificial intelligence lines up, you know, people assume that we're using machine learning techniques that are very good at processing text. That is not true. While there are HFT firms that do respond to news events, those are mostly news events where the formula of the news release is very well understood. It is a jobs announcement that comes on Friday at 8:30, and you know exactly what field to look in the news article to say, here's the number, I'm going to pop it into my formula, and out comes a price. Reading general news that might have an impact on your macro opinion is a lot harder to do, and that is years, if not decades away. So our value opinion is based mostly on a prior macro view that we have put into it by humans, as well as quantitative inputs that it derives from the market in real time. If a macro opinion changes, the strategy can't really update itself. Automated strategies are also optimized to perform well at scale. It takes a huge initial investment to put together a strategy that is going to trade, and the idea behind that investment is you do it one time, and then you can mass produce a product. You don't build an assembly line to build one car, you build an assembly line to build millions of cars. And so I would argue that a flash crash, and most flash crashes are a little bit different, is a very kind of isolated incident that is difficult to imagine building an automated solution to because it is not a one-size-fits-all scenario. Most automated strategies also are trained and tested on past data. Luckily, we do not have a large sample set of flash crashes to train on. But the reason is largely that we put together parameters. We know we're going to trade millions of the times over the course of the life of our strategy. We can look back over the last 6 months and just make sure that those parameters make sense, that the strategy behaves as expected. And training on past data is a huge part of what goes into strategy. Risk management in a trading strategy often involves de-risking in a related product. So that could be the most obvious product to choose here with the British pound is the futures product 6B, which is the British pound future. This trades on the CME in Chicago, and I'm sure that many automated trading strategies out there will make a market around the FX product, knowing that they can de-risk in the futures product. The next best product would probably be some other currencies. Stat arb funds, I'm sure, have ideas about what other things are related to GBP. Unfortunately, on October 6th, 6B halted for, I guess it was limit offer for 2 minutes and then outright halted for 2 minutes. So about 30 seconds after the crash started, 6B was halted, unavailable for market makers, which means that the market makers that depend on 6B are probably going to stop if they're smart, because otherwise they're taking risks that they don't know. They might be exposing themselves beyond what their credit allows them to, and they're certainly trading in unknown ground, so they might stop. And the last thing that's most important is that because computers can do as much work as quickly as they can, we almost always have a plethora of limits that we set in our algorithms that make sure that they are not operating outside of a known box of kind of expected inputs. And so I wanted to walk through some of those limits. Some of these aren't going to be surprising if you have ever worked on Wall Street because they are not surprising. Someone mentioned loss limits. If you lose too much money, you stop trading. How do we set the loss limit? The question is, well, we often will look at historical trading patterns and say, you know what, 90% of the time, our 10% worst loss is X million dollars. We'll set our loss limit to that number, and then we'll stop trading. We also have position limits, which is also very closely tied to our credit limits with our counterparties or brokers. If our position reaches a determined amount, we're not going to take a bigger position. If we're already buying as the pound goes down, we get to max position, we're not going to take any more. Market share limits, this one's a little bit more surprising. I was just told I have 2 minutes, so I have to rush along here a little bit quickly. This is a little bit surprising. If our strategy ends up taking up a relatively large market share than we would expect, normally we're trading 5%, suddenly we find ourselves making up 50% of the market, we're going to ask ourselves, something might be wrong. if that many people want to trade with us, we might be offering the wrong price. We will decide probably to scale back or stop our trading. If our data looks incorrect, if we usually get prices from two different markets that tell us what the pound is worth, and suddenly those two markets are telling us vastly different prices, we don't know which one's right. Our automatic reaction is, let's slow down. Risk management limits, again, if you can't trade 6B, you might stop trading. Capital limits, we have regulatory requirements we have to meet. If we get close to them, we have to start winding down our position. So I think the other thing that's important to talk about here is how big is the opportunity? I'm going to fast forward a little bit here. Only about, I'm going to glaze over this kind of quickly. I think that what happened here is a large trader, intentionally or unintentionally, sold somewhere between $200 and $500 million worth of GBP. I would say that they probably chose a pretty poor time to do that, given that this is one of the lowest liquidity times of the day. But either an error or some intent on their part, some emergency on their part caused them to do this. The market reacted not that poorly. I think they probably maybe lost 1 or 2% of the notional value of their trade to other counterparties, which is, if it's $200 to $500 million, we're talking about a $2 million to $10 million loss on a $500 million trade. That's not a huge loss to somebody who's in an emergency situation if they keep 98% of what they're trying to trade. And secondarily, it's also not a huge opportunity for market makers. If we need to invest a huge amount to build an entire infrastructure to identify these events, there's not a lot of opportunity there, especially if you're going to have to share it with 5 or 10 of the market participants. You're looking at collateral you have to set aside, infrastructure you have to build, people you have to hire and watch this, all for an event that might happen once a year. And if you get it wrong, you might be January 15th in 2015, when the Swiss depegged their currency, and the price didn't drop 2%, it dropped 10%. This could catch us off guard. We're not looking at the news. We can't automatically read the news and say, you know, oh, there's a macro reason for this. We should back away. And so this is difficult for us to distinguish between. So I guess I will try and wrap up quickly. Electronic markets find a clearing price with ruthless efficiency. Once they get an order, they are going to execute every single order they know about until your order is filled. Your order is completed. They're not going to give you a chance to cancel. They're also not going to give anyone else a chance to say, hey, you know what, I'll buy a little bit at that price. Most of them operate that way. There are some markets that will pause momentarily and switch to an auction model. So I guess you have to ask the question, is a flash crash where you get liquidity better than an old market where probably you would not be able to get any liquidity at all until time passes? Maybe the broker would not answer the phone. You also have to ask, is the cost of the dislocation, maybe $2 to $10 million, worth jeopardizing the execution cost of maybe $2.5 trillion of GBP alone that trade every year, or if you look at all currencies, far more than that. HFTs, I walked through some of our risk limits. HFTs are at risk in every flash crash, and we have developed a lot of automated limits that we use to protect ourselves. I think most likely institutions are behind on this front. Algorithms that people use to execute large trades probably not have appropriate limits in place. I'm not recommending regulatory intervention here, but I do think that it would behoove institutions to look at how they choose to do their executions and think about putting in responsible limits. The last point I would make is that there is liquidity in the market. It looks like there is not liquidity, but there's just no instantaneous liquidity. 11 minutes later, liquidity returns to the market. That comes from automated trading firms who have hit limits, have required human intervention to go and review trading, check macro conditions, make a decision about whether or not we can continue trading. That took 11 minutes to happen. Also, it probably took 11 minutes for other large traders who are ultimately the liquidity providers of a $500 million trade to wake up, look at the price, and say, man, that's a deal. I'm going to buy pounds. And so there is an instantaneous lack of liquidity, but it comes back. That liquidity is there, and we call that latent liquidity. It might not be expressed in an order book. A matching engine doesn't know it's there. It can't execute against it, but as soon as the price reflects an opportunity, the market comes to the rescue. There are some... I'm out, okay. All right, well, maybe we'll get a chance to talk about some of these during the panel discussion, but thank you for having me here tonight. Largely, my answer is I do not think we should be very scared about flash crashes. They happen, they cost us a little bit of money. They look scary, they undermine market confidence, but they actually don't cost us that much money.
Good afternoon. I'll be quick because I feel like most of my points have been made by everyone else, and there's so much that we can talk about on the panel. The generic illiquidity argument has been made, but I think we want to look at the facts and the data, and we simply don't have problems in this space. The dealer behavior during periods of market stress, and I'm also going to talk about future priorities. As has been well presented today, the bid-ask spreads, record lows, and frankly the times when we had illiquidity and these spreads blew out were during the periods of the financial crisis and Great Recession. The corporate bond market, similar circumstances. I think the argument and frankly the facts suggest that we have better liquidity now, post-Dodd-Frank, post-Volcker Rule, post-Basel III, than we did prior to all of that. And of course, again, the most illiquid period that we saw during the markets was during the financial crisis. The argument about the dealer behavior, whether the dealer will catch the falling knife, is a rather interesting one, and I hope to continue to debate it. The point I would make on this one is that during the taper tantrum in 2013, the New York Fed found that dealers with Tier 1 capital tended to reduce their positions even more than dealers with lower capital ratio, which is the opposite of what we'd expect to see if higher capital was to blame for reduced market making during stress. So I think these are interesting questions that we need to think about. And these points down here on the left-hand side suggest the change in the short positions and the change in the long positions during financial stress. Dealers are both reducing and their short and their long position during these instances of market stress, 2013, 2008, 1998 with long-term capital management, 1994 with what was going on with Mexico, et cetera. So I think we have to be very careful I think we need dealers making markets, but we do need to be very realistic about trying to not create a story that says dealers are going to be the ones that will step in during periods of market stress when the reality is markets need to adjust on their own, and we don't want to have periods of market stress. We're far better, as Vice Chair Fischer, thinking about the trade-offs between financial stability and what will create market stress versus trying to create this vision of liquidity that is not going to be there when we actually need it to be there. I do think that going forward, we need to be strengthening financial reform rather than reducing it, whether it's continuing to finish the rules of Dodd-Frank that I hope we can get done before the end of the year. And frankly, the parts of Dodd-Frank that and parts of financial reform that will have to be finished next year. And if they're not finished, those who don't finish it will have to be responsible for those decisions. I also think that the trend towards increasing market transparency is really very, very important. I think we heard today a lot of instances of insufficient data leading to a hard time analyzing what's really going on in the markets. So new Treasury market data reporting is extraordinarily important. The same is true with data in our bilateral and trilateral repo markets. I would argue that we need greater transparency regarding Volcker Rule compliance than we have had in the past. That will allow us to better debate the questions of, is the Volcker Rule working? Is it too tight? Is it too loose? Is it doing enough to enable real market making in times of when we need it? And how are the markets responding to it? I think that's a debate that we can have with sufficient transparency and in ways that does not endanger the actual minute by minute, hour by hour trading positions of the firms that are actually collecting that data. And I think there's multiple ways to do that, whether it's aggregated, whether it's time delayed, et cetera, et cetera. I do want to talk about, I want to mention three things that have not been brought up at this, I'll stop here. I'll mention three things that we haven't talked about today that I'd like to put on the table as very, very important parts of the conversation. And this is not in the presentation. One is the importance of investors as investors. We're talking about dealers, we're talking about trading, we're talking about abstract ideas like market liquidity, but when we step back at the end of the day, we want our capital markets to deploy capital to efficient long-term returns to the economy, to society. And that means investors engaging in real due diligence about where they should put their money. That's going to lead to returns for them, and we hope, according to the, how the economy works and how the capital markets are supposed to work for the economy and society. But the problem is, and this is what Paul Volcker calls the liquidity illusion, when there is a belief that you can get out too quickly at any price, at any amount, in any circumstance, then you have far less incentive to conduct the real due diligence into the quality of the asset you're investing in. And this is particularly true and particularly important here in the fixed income markets, where debt is debt. Equity is supposed to adjust to the value of the company, and it goes up and down, and you're supposed to trade that, and investors win and lose. But debt, we have a far greater economic and socioeconomic cost to things like bankruptcy than in the equity markets. And hence, whether it's folks like Paul Volcker who've said this, Chairman Volcker, or Sheila Bair, who have said that had we had better due diligence by investors acting as investors, they might have gone and looked at what was actually behind all the RMBS and the CDOs, and maybe today behind some of the CLOs, and found out what are these companies, what are these homeowners, what are these assets that we are deploying our money into, rather than looking, what's the last 15-day VAR on it, and the price, and where it's going to go in the next 20 days, and I'm going to be in and out before there's a problem. Let's not have a market liquidity system that incentivizes that casino-esque aspect to the markets. We need, obviously, arbitrage. We need liquidity in the markets, but I think we also need to look very carefully about making sure that investors are empowered and incentivized to truly be investors. A second point I'd like to highlight and put on the table is the importance of competition or concentration. The conversation has been, I think there was one interesting slide about smaller issuers having less liquidity. I think there's been talk about smaller, block trade sizes, a number of these other factors. A number of these factors may reflect greater concentration, whether it's in the corporate sector via the significant reduction in antitrust enforcement over the past 30 years, the large number of mergers and acquisitions, that some of our largest companies are bigger than they ever have been before. And hence one starts to wonder you start to think about why is there less trading in these? Well, perhaps it's because the prices are all moving in the same direction, or there is less arbitrage available, or there is less difference in management between companies. Or there are simply, if there are fewer entities trading in a market, you start to see a different behavior in just the capital trading markets itself. And that may itself lead to some reduction in liquidity. Another angle to that is, just thinking about the Volcker rule for a second, and I think it applies to Basel III as well, these rules don't apply in large measure to the non-bank market makers that are completely welcome to step in and make markets and make money and serve customers that need it. Are there obstacles to them getting in the market? Some might argue it's regulation, but we should take a look at all these aspects. We need to make sure that we have diverse, healthy, competitive capital markets, and frankly, a diverse, healthy, competitive economy. So I'd like to put that topic on the table. And antitrust may not be the right way to think about it in the securities or in the capital markets from what tools we use. But that's where you do start to look at other anti-concentration tools that are out there. Everything from Glass-Steagall to other aspects of Section 622, et cetera, from Dodd-Frank. And then the last point I would raise is we need to remember basic principles. Real market making is about serving customers, is about serving clients. It's about making sure that the real economy is working. And in a world where folks like Thomas Philippon and others have noted how the financial system, as it has grown in size, has increased the amount of rents that it extracts from the real economy. We need to think very carefully and very honestly about the extent to which we want to incentivize that type of behavior. I'm not saying we shouldn't have finance. I'm not saying we shouldn't have profits in finance, but I'm saying that we should be honest and straightforward about what is the appropriate role of finance in the real economy. And this is particularly true in a world where the financial crisis has had very large and continuing impacts on our economy, on our society, and on our politics. Last Tuesday's event, I don't want to opine on every aspect of it, but I think it is hard to ignore the fact that between 2001 and 2010, the average middle-class family saw 49% of its wealth collapse. 49% of its wealth. And while it's come back about 16% from 2010 to 2013, maybe another 16%, we are still probably 35 to 40% off of where we were in 2001 for the middle class. And that doesn't even count the height of the bubble from 2004 to 2006. So in other words, folks are genuinely hurting out there. And we need to be very, very careful about making sure that we don't go back into a world where we are empowering those very large, very well-off, and very successful entities to be betting against their customers, betting against investors, betting against the real economy, and creating a system, creating a culture, creating a capital market and a financial system that causes the kind of crash that happened in 2008. We simply cannot afford it. Thank you.
Kind of a point Jason made about flash crashes, right? As I read the Constitution, I don't see life, liberty, and liquidity as a constitutional right. And I'm somewhat reminded of an event early on in my tenure in the Obama administration when there was a giant blackout that affected Cleveland all the way to New York, and we all huddled for an emergency. And somebody said, what's going on and what the problem is. And one of the economists in the room said, well, the optimal number of blackouts is greater than 0. And I think one of the media people in the room said, we're not going with that talking point. Is the goal of regulation to eliminate flash crashes? Or should we expect 1 or 2 of these a year because the economics of the market justify that? And the costs of that regulation don't equal the benefits according to kind of the cost-benefit. I don't know, Greg, what do you think?
Well, I'll start with a note of humility because everything I know about high-frequency trading I learned from reading Flash Boys, which is a very dangerous place to start. So, but I think I genuinely, I thought it was very interesting, the numbers that even the person who was the victim of the flash crash who did not lose that much of his or her principal. And certainly, and this gets to the larger picture we've been talking about, there are a lot of very big structural changes going on in our markets right now. Equity markets, fixed income markets. I can't say that flash crashes periodically are the worst thing that's going on, or necessarily that they're causing long-term harm. I mean, I think I would look at them the same way I would look at some of the events, flash rally, Swiss franc, as is there something about this flash crash that makes me think that in the next financial crisis something really bad's going to happen that will exacerbate things? And I think that's certainly worth study, just as these other events are worth study. But I take the point that we have not seen something from that episode that would lead you there.
I think we have to take this in a very measured approach. I don't think all flash crashes are the same. I thought it was very interesting that it does appear that the short changes in prices appear to be reflect a new market structure that we have. And if that's a reality of it, then maybe that's something that we need to adjust to. But I think we also need to look very carefully and understand the operational details of events that appear to have no real economic consequence, and making sure that we've got all of the logistics, the operational, the back-end parts of the market working well, because we don't want these to occur by accident or in greater frequency than necessary. But I think we just have to take a very measured approach.
Well, I mean, would you guys agree, Jason? The optimal number of flash crashes per year is greater than zero? Would you say so?
I would say the cost of having 0 flash crashes is higher than having one. So
I'm not going to deliver an economic analysis, because I think that nobody wants flash crashes. So where the optimal number is may depend upon how much we can deepen our knowledge and understand it, and really figure out, can we fix it? Because if we don't understand it, we can't optimize it.
I don't want a blackout, but I'm prepared to accept that the odds of a blackout this winter with Pepco are far greater than zero, and generators are expensive.
Yeah, I was going to say, really what it comes down to, what's the cost of driving the number of flash crashes down to zero? And it's buying backup generators effectively, and it's how much does the backup generator, or restricting trading by a precipitous amount, what's the cost of that? So it's all cost benefit.
But I guess my point is we don't even know necessarily what the cost is. There's a lot of aspects of this of flash crashes in the markets that we're still trying to understand. It took a long time, and I don't know that even there's a full understanding of what happened in the May 10th flash crash. Across multiple markets, we have 2 different regulators collecting different pieces of information that are not talking to each other. We don't have a CAT in place at the SEC, a consolidated audit trail, to really break down and understand what's going on in the markets. So, we don't have transparency in the Treasury markets. I just think when we understand what's really going on, and when we can accurately evaluate the cost, then we could have this debate. But until then, there's a lot of work to be done.
Okay, so let's kind of stick on this theme here for a second. I want to pick up something that Debbie said kind of earlier, which was that she said, arguably there was too much liquidity pre-crisis. And so, I've often thought about this thing. In economics, we tend to think that most goods have declining marginal value. That's kind of not everything, but most goods. But sometimes when it comes to liquidity, there's a belief that it seems to have constant marginal value, that kind of more liquidity is always good, or is equally good going forward. And some people even kind of argue that it has increasing marginal. The tighter you can drive bid-ask spreads, even delivers more and more value. So I want to kind of ask simply to everybody, does liquidity have, in your opinion, declining marginal value?
Well, I'm happy to say yes, and I'll just basically restate the Volcker analysis and the principle of you need some liquidity. You need a capital market where people can move in and out. That's the point of it. But when there is too much liquidity, not only do I think there's declining marginal value, but I think you actually incentivize some of the bubbles and inappropriate behavior by investors who are not acting as appropriate investors engaged in the due diligence that they need to of their investments, particularly in places like the fixed income markets.
I think clearly there's declining marginal value. That's not to say it ever becomes negative. I'm not sure I would agree to that. If you have an instrument that trades every 2 weeks, it's probably better that it trade every week or every day or 10 times a day. But clearly when you go from 100 times a day to 105 times a day, the benefit of that is less than when you move from once a week to once every 5 days. So, almost by definition, I think it's declining. Maybe Debbie can hop up. I think a lot of this depends on how you define liquidity. I think liquidity in markets, I think it's generally always going to be positive value to having another market maker, someone else offering a bid and an ask. I think a lot of the problems with liquidity in the crisis were people, particularly monoline investment banks, were assuming they could get liquidity for securities that, in fact, maybe that's an illusion of liquidity, that they'd always gotten before by rolling over repo, and then they couldn't. So maybe in that sense, the market was delivering them too much liquidity for what they had.
Jason?
I would say I agree that generally marginal liquidity loses value. I think the bigger problem that you had said was it can give you a false sense of confidence that liquidity will be there forever. And it's not about there being too much liquidity at any given time, but if you expect that liquidity to always be there, you might be surprised one day.
And if I can add also that I think the nature of the asset itself matters. If we're talking about level 3, complex, hard to understand assets, maybe that's the type of thing that you need to have a different type of liquidity for, a different approach to understanding and investing in that asset than a very simple, corporate bond, whether it's a high grade or even a lower grade corporate bond. I think the complexity of the asset and all those things starts to matter as well.
Do I hear you, Andy, kind of slightly agreeing with Barbara Novak that the ETFs, by kind of creating more liquidity into that type of thing and making the asset a little bit more understandable and diverse, provides value?
I do think there's value in that, and I think that in some ways was the promise of securitization. I think we always have to be careful to make sure that simplicity and understandability and functionality are there and will stay there. But that's, I think, one of the things why the ETF market has been so successful, and why I think we need to continue to make sure it's successful.
I think ETFs are a complicated question that we've looked at a fair amount. It seems counterintuitive to think that you would have an asset that's more liquid than all of the underlying assets it holds. On the other hand, it is true that ETFs do not have the same redemption risk as an open-end mutual fund, in the sense that if someone redeems from an open-end fund, the underlying assets have to be sold to fund that redemption, again, unless you're holding a lot of liquidity, which they wouldn't want to do. Whereas with an ETF, simply the price changes. It has to do with the structure and the authorized participants and how they're created and retired. So they do seem to be more resilient to market shifts.
Can I make one comment on ETFs? ETFs are often traded by automated traders who are trading at kind of the efficient boundaries. So you can, you buy the product, you make a market in the product, and you convert it, or you create or redeem the ETF. But a lot of ETF trading also happens well inside those boundaries. And so to your point about the spreads being lower, a lot of it is simply supply and demand between people who are more interested in buying the ETF than trying to buy the basket of underliers. They're bidding more than it would cost to create the ETF, but they're met by somebody else on the other side.
Right. So we're going to turn to the audience after I do one final put everybody on the spot to something somebody else said. I'm going to start with Andy. Could you answer Greg's question about why we should apply one set of rules to non-bank affiliates, broker-dealers of banks, as opposed to broker-dealers of non-bank affiliates?
Well, we saw during the financial crisis that the non-bank affiliates of banks, when they failed, caused the Federal Reserve and the Treasury to bail out the entire entity. And there's multiple examples of that. Whereas we saw in MF Global or a number of other failures, non-bank firms that are standing alone can and will go down. Now, it's not to say that non-bank firms that are big enough and important enough, that they too will be rescued, whether it's Lehman or Bear or whatnot. So that's why I actually don't think it's about bank versus not bank. I think it's about, is this a really big, important, economically important entity, and how do we regulate that? But we do have a little bit of a contract that I think Vice Chair Fischer talked about between banks, which is why that's the starting point for this form of regulation.
I'm going to have to disagree with that.
Awesome.
I lived through a different financial crisis where the biggest systemic events were the failure of Lehman Brothers, which is not affiliated with a bank, failure of AIG, which was not affiliated with a bank, the failure of Bear Stearns, which was not affiliated with a bank, and really the busting of the buck at the Reserve Fund, which triggered perhaps the biggest systemic consequences, and it was nowhere near a bank. So I would have thought the lesson from that is that we really need to focus on the systemic risk presented by non-banks that actually don't have the diversification benefit of actually being affiliated with a bank. I don't recall, if you think about who bought these failed non-banks, well, it was JP Morgan, it was Bank of America, it was diversified banks who bought them to saving the government and the taxpayers a fortune. So I think it's a hard lesson to learn from the crisis that we don't worry about non-banks causing financial
We'll have to keep
stability
debating this later.
Yeah. So let me ask you to respond to something that Vice Chair Fischer said, which was regulation may have impacted liquidity. You're at one point a lawyer's lawyer. There's a big difference between may and did and shall. Would you agree that it's may, or would you say it has, one? And two, he put up a framework of systemic safety justifying liquidity costs, and I always get nervous in that framework because the only way to achieve financial stability that I'm aware of is to not have lending or fractional banking.
Right.
Everything else is instability. So let me ask you, how do you respond to those one and two?
Let me start with two, and then you remind me what one was. I mean, I think all the assessment of regulation has to be at the margin, right? I mean, there's no question we don't want to have another financial crisis. The question is, do we need the NSFR to not have another financial crisis? Or is the LCR and the ELSLR and the G-SIB surcharge and Basel III and CLAR and CCAR testing, quantitative and qualitative, are those sufficient to avoid a financial crisis like the last one? And so what is the marginal benefit? And then you actually have to think about marginal cost too, which is if the marginal cost of adopting the NSFR is to further drive down repo, is that putting at risk a financial crisis unlike the next one? And so that's why, I think he says it may have had an impact. I do remember the first question. I mean, it's hard to imagine it not, since a lot of these regulations were intended to have that impact. The goal was, and it was a good goal, they wanted to have less repo, regulators. I think the markets understood there should be less repo. So it's hard to say that a regulation that has had that effect and had that intent didn't have an effect on the market. I mean, you can argue, and I think with regard to a lot of these regulations, I would say the LCR, with very small, maybe a couple of exceptions, the LCR passes the marginal benefit to cost test well. I mean, it says for 30 days in a severe stress event, you look at the outflow assumptions around your liabilities, and you look at the stickiness of your assets, and you have to be able to survive that. That's a cogent rule with a well thought through rationale, and one where there was actually a lot of data applied to figuring out what those assumptions were. So yes, that passes. Our questions are more around things like the NSFR or an addition of hundreds of basis points to the CCAR exit ratios. Will that in and of itself prevent a financial crisis? Of course not. It's all the other things that will. And how much value does that add versus the cost?
So Jason, final question. You talked in your slide deck about your regulatory capital, which kind of surprised me a little bit because I'm trying to understand what regulation is binding to you. So could you expand on what that is, one? And two, would you be okay applying all the litany of alphabet soup to your end because you're not affiliated with the bank if you were systemically important, if you fit this household name test in a key market like treasuries?
Okay, so question number one. We're a regulated broker-dealer in the United States. We are a regulated broker-dealer in the UK as well, which passports us into Europe. And so for now. Probably for a couple more years. So, that comes with requirements. Some of our, for example, one of the issues up at stake right now is whether or not treasury trading should be required to be under the umbrella of a broker-dealer. Right now, it's not required. So, we're familiar with that regime. Obviously, the broker-dealer requirements are minuscule compared to what the banking requirements are. I don't know what half of the acronyms you've talked about. So I guess it would be premature to me to say yes or no. I would be okay with accepting some burden in that respect.
Bert, and then Seth.
Bert Ely, banking consultant, and thank you all very much for your comments. As you all know, we had a certain event occur last Tuesday, and I was wondering what your speculations might be as to how regulations might change for the markets that we've been talking about here, given some pretty strong pronouncements by the president-elect with regard to financial regulation.
Anybody want to say how we're going to make regulation great again?
I'll say one thing that may sound a little counterintuitive. I mean, clearly there's a lot of talk about, Dodd-Frank is now in more danger, and Dodd-Frank had a bad last Tuesday. What's striking to me, though, is that we look at the rules, and we've talked about a lot of them today, that are having, I believe, effects on market liquidity. It's things like, the ESLR. There's no ESLR in Dodd-Frank, right? There's no Collins Amendment, extra cushion in there. There's nothing in Dodd-Frank that requires the U.S. to have a significantly higher G-SIB surcharge than the rest of the world through the Basel process. So I think there's been a lot of focus on provisions of Dodd-Frank's, and maybe that's appropriate. But I think when it comes to sort of the plumbing of the economy, things that could actually stimulate economic growth, things that could reliquify to some extent capital markets, a lot of those are going to take a little more digging and a lot of thought.
I mean, I'll comment two things. One is I think, whoever ends up leading the team is going to have to look very carefully and think very carefully about what the underlying substance of Dodd-Frank means. It's easy to say I don't like Dodd-Frank because I don't like that word. It doesn't sound so good. But do you really not like loss-absorbing capital so that firms can absorb the risks that they take if they mess up? Do they really not like the ability to wind down a firm so that it can fail in an orderly way? Do they really not like greater transparency in asset-backed securities? Do they really not like the principle of big, important market firms are supposed to be market makers and not betting against their customers and their clients? Do they really not like, you go on and on, counterparty derivatives that are going to be a daisy chain of risk if one entity goes down and you have the rest of them go down, et cetera. So, I heard Donald Trump a year ago on Bloomberg Radio talking about how, the Volcker rule, good enough for Paul Volcker, good enough for me. So I'll take that. On the other hand, we're going to have to see what they do, and as I said before, if the new leadership takes actions that are really about concentrating wealth and power in the hands of a very small number of individuals, that's not what certainly is not what I think their voters sought, and I think there's going to be practical economic consequences, and I think ultimately political consequences.
I can't speak too specifically to the general direction of the next administration, but I would say that I have seen the cost to get into our business rise dramatically since I started the company in 2002. And I think one of the aspects that is most beneficial to a healthy market is having diverse market participants. And to the extent that it is harder for new entrants to get involved, I think that leads to a decrease in diversity in the market, and generally that means more expensive use of the market.
So I'll just say that I just put up a post. It ran on Bloomberg Gov and also cross-posted at Brookings on this. I've been very confused by the president-elect when he was candidate. 1 minute it was Dodd-Frank and regulations are killing banks. The next minute was bring back Glass-Steagall. He said that he's for, that in the Senate, that was Senator Warren and McCain. He said he's for audit the Fed, which is the support of Senator Bernie Sanders and Rand Paul. And, which Trump are we going to get? Are we going to get the one that is kind of classic, simple deregulatory? Or are we going to get the kind of, one that, takes these kind of things that have bipartisan support but are kind of very opposite direction as to how we responded on the crisis? I don't know. That's my piece in a nutshell, but it's more eloquent if you read it. But the one other point I'd add to you is we're a little bit used to, I would argue, the last time most of the regulators were on the same page. Roughly speaking, there weren't quite as many fights, or if they were, they kept them a little more internal. If this week the transition team's already turned over once, if not twice, you may have a situation where you have each of these different viewpoints articulated at a different regulator. So you have a lot more of an inconsistent warring kind of framework within, and Lord knows, if you didn't know all the acronyms, Greg talked about rules, the acronyms on the number of regulators we have is astounding and I think a source of financial weakness, systemic weakness. Seth?
Thanks, Seth Carpenter from Rocco's Capital. Aaron, if you thought they were all on the same page, you haven't been to recent FSOC meetings. But, so most of the comments for Greg, but if other people have opinions, I'd like to hear it too. The first was about the bank-affiliated versus non-bank affiliated. I personally thought that part was a little bit of a straw man because all of the sort of SIFI designation for non-banking institutions clearly takes that seriously, and the Money Fund Reform Act clearly takes it seriously. So I'm sympathetic to the notion that one needs to look at where the problem is, not just simply look at banks because it's easy to pick on banks, but I don't think that's where the problem is. More specifically to your commentary, you said one needs to take anecdotes more seriously. I'm very sympathetic to that. When I was Assistant Secretary for Financial Markets, I had a whole parade of people in from the markets telling me all the problems going on with liquidity. So this conference has been near and dear to my heart. On the other hand, I spend a lot of time on a trading floor now, and I know that traders have massive amounts of cognitive bias. And so anecdotes are not, in my view, small bits of data. So I would think if the anecdotes actually do have the value that I personally believe they do, I don't think these people were lying to me about what they were experiencing, then the illiquidity that they're talking about should show up somewhere. So where in the data should we look to demonstrate that there is this illiquidity? In my view, we can't have a meaningful discussion about what's wrong with markets and whether or not it's regulation that's causing it and whether or not it's anything else that's causing it, unless we're actually seeing the same things. And all of the charts that were put up before, I created slide decks like that when I was at Treasury. I don't personally think of it as dispositive because I hear all these anecdotes, but I'm left wanting a little bit more. I want to have a better argument about it. I want to be able to say, yes, there is some decline in liquidity. Here's where it is. But because the system is safer, because the system is more resilient, it's worth it.
Right.
So how do you bridge that tension?
So on your first point, I mean, I think the problem with the FSOC designation is it's all or nothing. And there may be institutions that you would not say are systemically important, but 10 of them combined would be systemically important, sort of like mortgage companies or things like that. And so you have institutions now that are the leading market makers, and I think somebody was referring to the fact that when they did the Treasury study, they didn't know who half these people were. So those people together might actually be systemically important. Right. So I think maybe that's a problem with the law, is that you either have to get the full treatment, or as a non-bank, as a non-bank that's not affiliated with a bank, or if you're a non-bank that is affiliated, you get the whole bank regulatory regime. And I'm old enough to remember back when you actually regulated non-bank affiliates very differently from banks, on the theory they have 23A that protects the non-bank from the bank. And so you wouldn't have the same standards. You'd let them do more things. You would let them do things with less capital. And so we've just sort of morphed, and there's now this it's just sort of a porridge of why we're regulating that I don't think's really been thought through. On the anecdotal point, I take that very seriously. And if I and I think others were only hearing this from traders, of course, they're a unique breed. But I've sat with asset managers who are the end users here and say, I can't get my trades done in size. I'm holding more liquidity. I'm holding smaller positions. I take a lot more from, it was only up there briefly because we're in a hurry, but the CFA survey of users, I put a lot more stock in that than I would in a survey of dealers who can certainly talk their own book. And I think a lot of it, and I think Debbie got to this too, is the real problem with the data, I think, is it's the discouraged worker problem. And you just, to the extent that the buy side has gotten sort of accustomed to not seeking large amounts of liquidity, large trades, and doing large block trades, and doing them over a longer period of time, and so not expecting immediacy and not expecting size. There are sort of long-term costs for that in the economy. Those are very difficult to measure. That doesn't mean they don't exist. And then the other, and that gets to the slide that I think several people refer to, Martin had from Goldman, is what are the effects for smaller issuers who don't have the benefit of being the liquid issuer, and then also for, I think somebody mentioned, BlackRock's always going to get its trades done. So is Fidelity, right? But are you concentrating assets in large asset managers who are the only ones with the market power to get their trades done? So I think there are a ton of issues around that. I'm not saying that there's a crisis and something needs immediately to be done to fix all that. I do sort of ascribe to the first rule of holes, which is if you think you're in a hole, I'll modify it slightly, stop digging. And I think NSFR, GSIB, Basel IV can constitute still digging. And then thinking about something Aaron was saying, I mean, not only do you have a lot of diversity of views in U.S. agencies now, I mean, you have an open revolt now in Europe against Basel IV. Finance ministries, and Asia never bought in. So, between European and Asian finance ministries, they have said, no, we did the call of evidence. We understand there's an impact on economic growth and market liquidity. We can't do capital markets union, with this level of capital. And so they're going the other way. And so the question is, are we going to keep going in the opposite direction?
Great. Well, I want to thank the panel, Martin.
Thank you very much, everybody, and thank you to the audience, and appreciate everybody that's been here. Thank you for coming.